Hello, everyone. Um, this is my ISM presentation, and as you can probably tell, it's about how I can become a better investor. So, for some background, oh, so why am I interested in investing? It's kind of like a game. Everyone's in the market, only looking out for themselves, trying to maximize their own profit. And billions of people like acting together, like all in self-interest, like actually like moves the market in like certain ways, and that's quite interesting to me. And investing isn't taught. All right, investing isn't taught in school, and a lot of like especially new retail investors, but even experienced and seasoned investors can make illogical choices, irrational choices. It's very easy to like try to point out what the optimal choice was in retrospect, but when you're losing all your money, or when you feel like you could turn that money into even more money, like it's very easy to make bad choices. And I want to figure out how to kind of game it if I can, and just make the best investing choices, and that's going to bring me a long way in the future. And why is it important? Well, investing can be profitable. It's a wonderful way to turn the money you have into more money, and who doesn't like more money? So, my interview was with my dad. The the main takeaways were that like the market is based on predictions, and those predictions are based on how well the economy is doing, but it's not always one to one. Things can be overvalued and undervalued. People can panic, and it's much more psychological than you'd think. Um, there's like business cycles, like market cycles. That's how like bubbles happen. The 2008 financial crisis, to name like a famous one, but there have been a lot more than that throughout history. Yeah, and it's all about people just having wrong expectations, and that's how like the market crashes. It can go too high and too low. Um, and not losing money as an investor is just as important as making money. If you feel like you could make a little bit more, but like the risk is too high, it's not good to take that risk. It's good to know when to cut your losses. And the inverse is true as well. Sometimes it is best, especially if it's like a company, not an index, which I'll talk more about later. If it's like one company that you're banking on doing very well and the stock starts to decline, sometimes the right decision is to sell even if you have sold at a loss. But with bigger indexes that have like a basket, like let's take the S&P for an example. It's a basket of all the largest companies in America. The American economy probably isn't just going to collapse to zero. There are people in charge of like making sure that doesn't happen. So the S&P actually plummeted quite a lot recently because of Trump's shenanigans. Uh, but yeah, and it did go back up after, because they have like all these people, like the Fed, everyone like making sure it's doing well. So in those cases, it's not good to sell at a loss. Um, yeah, and successful short-term trading is kind of, it's a bit pointless, but actually I want to try it. But it can be a bit pointless if you're competing with multi-billion-dollar companies. They have all of the smartest traders in the world, all of the like best information, best algorithms, best people to make those algorithms, all the real-time data. They're all communicating and bouncing ideas off of each other with like billions or like tens of billions, maybe hundreds of billions of dollars behind them. It can be like, it's kind of a losing game. That being said, I still want to try it though. It seems fun. So my three ISM goals can be broken down into understanding the driving factors that move the stock market um, in the long term and the short term. The second goal is spotting profitable short term trades. which, yeah, and from the interview, I learned that it was kind of pointless, but it seems like fun. I want to try my hand at that in the future. And I also, the third goal kind of like wraps it all up. It's like understanding the best places to put your money in at certain times. Like when the economy's doing well, the rule is like stocks go up a lot. Stocks are really good investments. When the economy's not doing well, things are like unstable, then like assets, like anything from like gold and silver to like houses, those are better. So for my first ISM goal, I learned, as I said before, the market is like ultimately based on speculation. The price that you see isn't like the company hasn't just like spit out that price per share. There are like the free market has like lots and lots and lots of people trying to predict what the price is going to be, and that's what moves the stock market. So technically the best way to do it is like predicting the predictions, kind of like see what everyone's thinking, see if it like try to make your own assessment, see if that aligns with reality, and if the general consensus of the market doesn't align with reality, like that's where the space to make some money comes in. So and that kind of ties into the third point. Big spikes and dips do happen. If any of you guys invest at all or have seen like anything on the news about the massive dip the S&P took, and then like in a day it was like a 20% drop, and then in a day it was like it spiked up because like the Fed interfered or like intervened in that. Yeah, but big spikes and dips in the economy like do happen. But especially if you are invested in an index that tries to represent how well the country's overall economy is doing, you're usually pretty safe to just hold, even if your shares are less valuable now, because the loss is only realized when you sell the shares. Once you sell the shares, even if they go back up, you still don't make any money. So that's another important rule. So ISM goal 2, the short term. Short-term trading it can be fun, and it seems like a good way to make a lot of money, and it can be a good way to make a lot of money if you do it well, but it can also be a way to lose a lot of money, which we don't like. So yeah, it's generally best left to experts, or at least people with a certain level of expertise, like those big banks that hire all those smart people to figure out what the stock market's going to do next in the short term. Yeah. So the best investments, this is just kind of a simple rule of thumb. To reiterate, when the economy is doing well, you want to be holding stocks. When the economy is doing badly, you want to be holding assets. But that doesn't mean like when the economy is doing well, you invest into stocks, because like you want to buy low, sell high. It's like it's like what people like. I mean, yeah, it's very nice. You know, you buy something for cheap and sell it for expensive. And when the economy is doing well and the stocks are really high, they're not going to go up forever. People like start investing. It's kind of like a snowball. People invest more and more as the stock does better, but then eventually the market realizes that it's overvalued, and the stock like plummets, or not plummets, but goes down, plummets depending on how badly it was overvalued, or maybe just gradually decreases over time. So you want to hold both assets and stocks and sell like at the right time. And what I just said, for stocks doing well, when the economy is doing well, assets do well in the same way when the economy is doing badly, because because they have an inverse effect on each other, kind of. So I'm trying to think of how to explain it. If you hold something, a real asset, it like keeps its value, uh, even if it's independent of the economy, it's independent of companies because you own a thing that's private ownership. That's something that you own. You're not investing into the things that the company owns. So yeah, or a lot of companies own if you choose to go with an index. So my Padlet, it's quite brief. It wasn't my it's just like my trades, which was only really one trade. We'll get to that later. So the challenges I felt was when I invested in the S&P, it did go up. I invested actually after it spiked up, which kind of goes against my rule, but I had a good idea it was going to go up a bit more. I invested at around 5,200 per share and sold it at almost 5,700, so I thought that was pretty good. But then it went up even more, and it was like, oh, I could have held onto it longer, but that's not a good way. That shouldn't change my risk assessment approach. I knew when I sold it that it could go up more, but I still chose to sell it because I thought I'd rather cut my losses here and just take this extra cash home, which I did. One thing I did learn though was sometimes it's a good idea to wait until the stock market reopens because it's open during a certain amount of hours during the weekday, and depending on what companies you're investing in, what countries they're from, the stock market will be open at different times. This particular trade I sold just before the stock market closed, and then Trump dialed back a bunch of tariffs later, and that made it shoot up by a couple more percent. But I should have done more research into that because at the time I was just thinking maybe things stay the way they are, maybe it keeps going up and down. I'd rather just quit while I'm ahead. But yeah. And for these top right, in progress, that's investments I'm thinking of. So European defense, a lot of this goes back to this one guy, Donald Trump. He's the leader of the most powerful country in the world right now, depending on how you measure that. Definitely a very influential country. So the things he says and does, has a very big impact on the world. And for my project in particular, the stock market, he kind of left Europe out to dry for a bit, pulled back a bunch of military forces from Ukraine. If you know anything about Europe's attitude, it was always the US will protect us, we don't need to ramp up our military. But Trump's antics kind of showed them we need to get ourselves together. They actually very rarely for Europe, their leaders actually got together and made a decision, which was they're gonna invest more into their military. They're gonna force countries to allocate a certain amount of GDP to military spending, and they're putting funds into the military. And the big idea is they want to have their own military-industrial complex, which is that system of companies that produces weapons and sells them. They want to have that in Europe instead of buying from the US because they don't want to rely on the US anymore. And that made me think that European companies, European defense stocks would go up quite a lot. So that's an idea I had. But they've also already gone up a lot because a lot of other people have had that idea. And that overvaluing thing that I said before, with some of these stocks, that's starting to happen. People have too much hope in the stock, so it might crash later. And I waited a while. That's a common theme as well. I always wait too long if I have an idea. But then I can say that for all my good ideas, but then all my bad ideas where I waited too long and didn't do it, so Chinese tech, just because they seem to be very efficient. They did that whole thing with DeepSeek. I think the Congress in the US allocated around $500 million of funding to improve like ChatGPT and like what the US market offers to the world in terms of AI, and China beat them out with $6 million because like they like govern a bit differently. The government has a lot more influence in what the companies like actually spend their money on. So in the US, like markets, sometimes the company's main objective is to just squeeze as much money out of the government as possible and just like give them something they'll be happy with. But China's like actually giving them the money and then like looking at what they're doing, which is why I think their like R&D has a lot of potential, especially tech. So I might want to look into that. I have some, yeah, Xiaomi looks good. That's one I want to invest in. And like UK housing, just because it seems to like always go up in price, which is very bad if you live in the UK, but like it could be a good investment. Obviously, I can't buy a house with the amount of money that I have, but I could like look into partial ownership, something like that. All right, so current investments, I already sold that S&P. I have a warrant on the S&P 500, which basically means I'm betting on the S&P in the opposite direction. I think it's gonna go down. And I was actually quite wrong about this. I did this like 2 or 3 days ago and it went up a bit, but it expires in a year and it's been like 3 days. At some point, the S&P 500, especially with like Trump at the wheel, I think it will dip below that price. And when it does, each percentage point it dips below that price, I make 7%, if that makes sense, because the warrant's kind of a multiplier. But that's the same in the other direction too. So if it goes up by 1%, I'm like down 7% in what I invested. So yeah, and also gold, just because I think like the stock market's like volatility recently has like made a lot of people, like especially like wealthy people who store a lot of their money in the stock market. It's made them a bit nervous. They want to move to like precious metals like gold because they can tend to be more stable. Gold also has already gone up a lot. I'll see how that goes. But my thinking on that is that wealthy people who hold their money in stocks, they've like seen what happens with the S&P. It drops like 20% in one day. They like don't want to deal with that, or maybe they just want to have like more stake in something like gold. So like less of their wealth is like constantly seesawing. Yeah. So to go back to that S&P 500 thing I was talking about, this is like the exact numbers. So on April 10th, I invested at $5,268 a share, and on May 9th, I sold at $5,659.91 per share. Don't know how important the 0.91 was, but yeah, so that went pretty well, but as you can see, it went higher later. That was the whole like, oh no, like I could have sold later thing I was talking about, but again, that shouldn't change my approach to risk assessment. The way I invest, I always want to be able to quit while I'm ahead and like minimize the chance of losing. And if I am losing, I want to like get out in the way that like causes me to lose the least. I don't want to like stay on something in the hopes that it goes like higher or like lower, because that's like, the stock market is gambling, but that's just like real gambling at that point, which I don't like. So my overall goal, there were like 3 ISM goals, but my big mission, my final project was investing to like beat the inflation rate. And obviously like by extension, like a savings account, because they very rarely beat the inflation rate. Obviously there's less risk, but yeah. And I was successful in that. If you look at both Hong Kong and the US, my investment over 1 month was resulted in a 4.6% increase in the amount of money that I had. And the annual inflation rate in Hong Kong was 1.6%, 1.8%, and the expected annual inflation rate in the US was 3.6%. So in a month, I've like beat out both of them, but it should be said that like in that month, if you invested really low into the S&P, when that was happening, like almost everyone who still held like shares of the S&P like made a lot of money then, just because it was like shooting up after the panic that everyone had with the like tariffs and everything. Oh, 3.1% was the US inflation rate, my bad. Okay, so future investing ideas, I mentioned them in the Padlet, mentioned the reasons: European defense, they want to build up their industry. Chinese tech, I just think like China's system of governance allows for like very good R&D, which like, by the way, R&D is like research and development. It's like actually like figuring out how to make things better, how to make things like, if you had like a car, how to make the car like faster, how to make it more like cost efficient, how to make it more like comfy if it's like more of a luxury vehicle, just making things better. And I think China's like gonna be quite good at that. They're already quite good at that. And UK housing. So my acknowledgements were, is everyone here? Yeah. Mr. Blurton, Mr. Sam, Gino Lee, Adam Preece, my dad, and Andrew Gilbert for being an amazing advisor. Thanks for listening. Any questions?
As a person who like use investment as like a ISM, which stocks would you like recommend to like dummy invest in a basket?
I wouldn't. I don't really like the idea of making my own basket. I just like investing in like indexes because it's easier. Making your own basket like can be a good idea, but like only if you're like very good at like picking out stocks, which like most of us aren't. Like I guess Warren Buffett could be a good example. Like he got very rich off of like picking the right stocks, but it's like very hard to do that. And personally, like I don't think I could do that as a pretty new investor. So I just go with an index like the S&P if that's the American economy, and there's like a bunch of there's an index for like every economy, basically every industry in that economy, and like every economy has like an index. So I think those are good, like big basket pre-made.
Thank you for your amazing presentation. Just want to ask, with all the like politics going into like influencing the global market, and there could be a global recession according to Wall Street. Do you think what kind of stock would you encourage new investors to invest in this current situation?
Well, I'm actually personally betting against the economy. I'm betting on stocks going down. So personally, I wouldn't advise investing in any of the big stocks right now. If you want to like do your own research and find like up and coming companies, that's always a good strategy. But I'd say like if you think the economy is going to crash, wait for it to crash and then buy stocks because then they'll be cheaper.